Okay, good morning, everybody. Ben Mendenhall, the administrator of the Centennial State Liquid Investment Pool, Colorado's newest LGIP, available to local governments. We are happy to have everybody here today. Just as a quick reminder, I've spent the last 18 years of my career assisting local governments with their investments, dating all the way back to 2006, which is truly hard to believe. I've worked with many of the people that are on the phone today. My role here at CSLIP is to run the fund on behalf of the board and to be a free resource for you out there to help you with cash flow forecasting, investment policies, taking a look at your investment program, just providing some guidance. But really, CSLIP is a daily liquid local government investment pool, very similar to the other three that you are all familiar with. And today we're going to talk about the differences of between money market funds, local government investment pools, and bank deposits. And what makes CSLIP unique is we have an independent investment advisor that has been retained by the board, being State Street Global Advisors. And today with us, we have Will Goldthwait, who is the portfolio strategist for CSLIP at State Street Global Advisors. And I'm going to pause there. And Will, do you want to give a background for those of you that may not have seen you speak before on some of our previous webinars?
Sure, absolutely. For those that are not familiar with State Street Global Advisors, we're the wholly owned subsidiary of State Street Bank, which is the first or second largest global custodian in the world, depending on, you know, what what date you snap the line. It's between us or Bank of New York Mellon. So we're the fourth largest asset manager in the world. We've got $4.4 trillion of assets under management, of which we've got about 560 billion in cash assets. So pleasure to be working with CSLIP on this new LGIP in the state of Colorado. My background is I've been at State Street for a decade. I've been here for 10 years. And then prior to that, I was in sales, similar to what Ben is doing, relationship management, talking to you folks out on the road, traveling around visiting clients. And then prior to that, I spent about a decade as a portfolio manager. So I've worn a couple different hats, and I love my current role in being able to connect with folks like Ben and folks like yourselves on the line. So I'm hoping this next half hour we spend is very educational. We would encourage questions. I can guarantee whatever question you have in mind, someone else is also thinking. So all questions are good questions, and we really appreciate you asking. Ben, back to you.
All right. So where we're going to start is with really just having a discussion. And to Will's point, this is designed to be very interactive. So if something comes to mind and you don't want to wait to the end, feel free to interrupt us. That's what this is designed. We're really trying to structure these more as a podcast, if you will, than a webinar. So we're embracing the younger generation's terminologies here. So to start the conversation today, we're really going to start with banking, talking about banks and how they operate and what the safety mechanisms are compared to some of the other liquid options that you have out there. And that's really what the framework of the discussion is around today is safety, liquidity, and yield. Those terms that you hear all the time, and really just giving you some differences here because a lot of people think that your money's in a bank and it's similar. Anyway, we'll get into all that. But here in Colorado, as many of you are aware, our state has done a really fantastic job of setting up extra safety nets for public funds as a result of many instances in the past that created some turmoil, if you will. So here in Colorado, when you have money in a bank, whether it is a big national bank, a regional bank, or a local bank, those deposits need to be collateralized, and they need to be collateralized at least 102%. And where we're coming from, where this stems from, is from the Public Deposit Protection Act here in the state of Colorado. And again, that's a great safety net really put in place to protect the public funds out there from the deposit level. And as we all know, FDIC insurance covers up to 250,000. And where the Public Deposit Protection Act comes in is many local governments have more than 250,000 that they need to have in bank deposits. And the Public Deposit Protection Act on those amounts above 250 require that those individual banks collateralize your assets at least 102%. So for every penny or every dollar of public funds that is in a bank, that needs to be collateralized at least an extra 2 pennies or extra $2. And what's interesting, and I'm going to field a question to Will here, but what's interesting is how they collateralize these securities. And the simple answer is they're buying all the same securities that you would see in a local government investment pool or a money market fund, very short term instruments that are backed by the full faith and credit of the United States government and some other instruments that are out there. So it is interesting, really when you get outside of Denver, you see a lot of the local governments put money in their local banks, and you tend to see a very large spread in yield. Some entities at their local bank will be getting, in today's rate environments, most money market funds and LGIPs are paying anywhere from 4.75 to 5. So let's just use 5% as a good kind of discussion topic here for a rate. Usually with these short-term liquid funds like an LGIP or a money market fund, you'll see much higher rates because of that cost of collateralization at these local banks where they have to collateralize at 102%. That gets very expensive for them. So really what you see there is a lower yield. And it's great that your, money is in a institution that everything is protected. And look, I've been an advocate over my 18-year career of you always want to have money in your local banks, whether they're a national bank or regional, et cetera, because there may be political issues, there may be supporting your community, a lot of these factors in there, the banks are very, very important. But also when you're looking at safety, liquidity, and then yield, if safety and liquidity are the same in a bank deposit, a money market fund, and an LGIP, then you got to really start looking at what the yield is. And if the money market funds and the LGIPs are paying 4.75 to 5 and your bank is paying you 2%, well, there you go. So you really want to work with a financial professional, whether it's myself or there's many out there that can help you take a look at your cash flow and really peel back what's important to you as an individual entity. Because as we've learned, there are many different ways to invest public funds in Colorado. All of them are right as long as you're staying within your investment policy and state statutes. So that's something you want to consider there. Now, that's just kind of scratching the surface on the banking side. But Will, can I turn that over to you and just maybe talk about what you've seen in that area over the last couple of years, and maybe add to help frame out the banking side of this presentation?
No, absolutely. Thanks, Ben. So I think the part that I really want to focus on is like where we've been and where we are now. So when we look back from the period of 2009 to 2014, when the Fed first raised rates by 25 basis points, we had a zero interest rate environment. That meant that bank deposits were pretty much pinned at zero. It meant money market fund yields or local government investment pool yields were pretty much pinned at zero. The whole front end of the fixed income market was completely compressed. So there really wasn't much differentiation between yields. And so folks just kind of shrugged their shoulders and they're like, it doesn't really matter. I can put it in a collateralized bank deposit. I can put it in a liquidity pool. And it doesn't really mean too much. When the Fed began to raise interest rates in 2015, 2016, and then in 17 and 18, when actual interest rates are up over 2%, all of a sudden people just started to look around and say, wait a second, there is a difference now. I can differentiate between instruments. And when I say I'm just sort of referencing what Ben was saying. A lot of people that I talk to don't have the ability to put their monies in bank deposits that are collateralized. In that case, if it's not collateralized, then you are at risk to that bank's balance sheet, right? Whereas in the state of Colorado, you have got a unique scenario where the banks have to specifically hold assets as collateral against that deposit for you as an entity. So that's different. So then we really can say, okay, if this is from a risk and liquidity standpoint, apples and apples, then what are those yield comparisons? So 2022 was an incredible year, a record-breaking year in so many regards. It was the first time the Fed had raised rates going from 2022 into 2023 by 525 basis points in such a short amount of time. Even going back to 1994 and even going back to the 1980s, when Fed funds were up at 2%. They hadn't gone up 525 basis points in such a short amount of time. So that really opened up people's eyes to what was going on from a yield perspective. And so when we think about how do we generate those yields, there's a lot of questions that go into that. Ben, I don't know if you want me to just sort of talk about that or if there's any specific questions you want to ask me about it.
No, I think I've got some questions, but I mean you're flowing pretty good here, so I would just say keep going, and then I'll ask you some questions as we move along here.
Okay, cool. So when we're putting together the portfolio, we're looking at what our guidelines allow. So CSLIP has put together specific guidelines that we have to manage the portfolio to. So I can't just run out and buy anything that I want to buy. I have to make sure that we follow those guidelines that CSLIP has set out for us. And those guidelines also follow Colorado code. So that's very, very important that we're following the code in the state of Colorado, ensuring that we're investing in line with that code. Not only do we have those guidelines, but then we also have rating agencies. S&P will give us a AAA rating because we also have to follow their rules. We also have to be vetted by them. So S&P will only give us a AAA rating if we comply with their additional constraints that they put on the portfolio. And that could be further rating constraints, that could be duration constraints. There are specific ratings that come with that AAA rating. So not only are we operating with Ben and his team's oversight, but additionally a third-party rating agency, their oversight. Additionally, there's all of you, the investors in CSLIP. They're looking at the yield, they're looking at the holdings, they're analyzing this. So there's some comfort to know that not only are you looking at it, but there's other investors that are looking at it as well. And this is something that we actually hear quite a bit from our clients that we like when we're in a commingled vehicle like CSLIP. And we manage a lot of these vehicles, and we like it because we know that not only do you have the guidelines, you have state regs, you have the oversight of the administrator, CSLIP, and then you also have the rating agencies, and you have all of the other participants in that pool looking at what we're doing. So that's a very, very important thing. A lot of eyes making sure that we're doing the job that we're supposed to do. Ben, you had a question?
Yeah, so this is a really nice dovetail into a fundamental difference between an LGIP and a money market fund. And you touched on a little bit. Money market funds are regulated by the Securities Exchange Commission under SEC Rule 2a-7. And local government investment pools are Rule 2a-7 like. They must emulate Rule 2a-7, but they're regulated by the individual states that they're in. And some states have a state-sponsored LGIP where the state treasurer's office runs the LGIP. Colorado has all independent or privately sponsored local government investment pools that are run by, again, the Board of Trustees, overseen by the participants that vote the Board of Trustees, but then ultimately is regulated by the state of Colorado. So can you talk about where that could be an advantage for a local government participant or looking at if they're trying to consider between a money market fund and an LGIP, maybe just talk about what you would see, what you would be looking at there from your perspective and in your past, what you've seen that can help with that decision.
Yeah, absolutely. I mean, I think your comment is really good. 2a-7 like. So what CSLIP is able to do, what we're able to invest in, it's got some different rules than what the SEC says. So the SEC has an accounting calculation method that requires prime-like money market funds to use mark-to-market accounting. So they cannot account for the NAV at a $1 steady NAV. CSLIP can. CSLIP accounts using amortized cost accounting, which means that you subscribe and you redeem at a steady $1. So that makes, from your standpoint, from the constituent standpoint, it makes the accounting much easier. You're not trying to factor gains, losses. You're not trying to figure out what price you're subscribing or redeeming at today, you know that it's a $1 steady NAV. So that's a big difference. Additionally, there's no fees on redemptions if they meet certain criteria, which is what the SEC has just done on prime funds. So for prime funds to the SEC, they say if it meets a certain redemption qualification, then the fund company must calculate whether a fee needs to be applied according to that redemption. So this is something that is a byproduct from Lehman Brothers 2008. The SEC went and made a whole bunch of different rule changes. But the benefit of CSLIP and liquidity pools is they looked at their investor behavior, they looked at the shareholder behavior, and they recognized that to use the expression, we don't need to throw the baby out with the bathwater, right? We don't need to, design a rule that's going to look at all of these vehicles as the same because investor behavior is very different. And so that's really important. And that's a huge advantage to having a liquidity pool based in the state of Colorado that can determine the rules around what the investor experience has been in the state of Colorado.
Yeah, and that's a really great point. And in my experience, and I've got some questions for you about SEC Rule 287, but in my experience, I've worked in other states in my past where the only option for an LJIT is a state-run LJIT. And some of the local governments had asked me in these other states saying, Ben, when you're looking at an LJIP, you guys have three independent now, four independent. What do you see there as a main difference? And what I would always say is, well, if you feel comfortable as a local government with a state treasury office making all the decisions on your behalf, and it's really kind of a dictatorship, they do what they want to do, or do you see value in a locally run local government investment pool that has a board of trustees of all of your peers that govern the fund? They control all of the service providers like State Street or a me, for example. Do you feel more comfortable having state oversight and doing everything, or would you rather have an independent there? Because boards aren't going to go outside of what the state statutes are, but they may be doing things that the state doesn't do. So there's more flexibility there, I think, is something that really is an advantage to an LJIP over money markets. But I do want to circle back to what SEC Rule 287 is, well, because that is the driving force on what the liquidity requirements are, a lot of the structuring and the duration of the portfolio. So can you just give us an overview of what SEC Rule 287 is and some of the liquidity requirements and what changes they had made after the financial crisis? I know that's a big question, but anyway, talk to us about SEC Rule 287.
No, I mean, so like when we're thinking about risk in the portfolio, right? There's really two levers that you can pull on to add or subtract risk from the portfolio. First is duration, like the maturity ladder that's in the portfolio. How far out have you bought certain assets? How long do those assets have to mature? So what the SEC uses and what we also use for CSLIP is this concept of weighted average maturity. So we take all of the investments in the portfolio, we weight their maturity, and come up with this weighted average. And so we don't allow a weighted average maturity to be longer than 60 days. So in 60 days, if I maxed out that maturity, I would never take it all the way to 60 days. But let's say I took it to 52 or 53 days, it would be 53 days before the maturity structure in the portfolio had completely rolled over, on average, right? So that is a measure of changes in interest rates and the sensitivity to changes of interest rates. So when we think about that period in 2022, when interest rates were going up by 75 basis points from one Fed meeting to a next, having a very short weighted average maturity was critical. During that period, the money market pools that we were managing, the liquidity pools that we were managing, they had average maturities of 7, 8, 9 days because we knew we wanted to have that portfolio be very sensitive to interest rate changes. In other words, we wanted to capture those 75 base point rate hikes when they happened. And so that's what we do. Now, where we are with that maturity waiting is longer. We're out at 30 days, 40 days. When I look at the portfolio right now, it's got a weighted average maturity of 43 days. That's because we're anticipating that the next move the Fed makes is going to ease policy rates. So we want the yield on the portfolio to drop more slowly than a bank deposit would. As soon as the Fed cuts by 50 basis point, the bank deposit, that yield will drop immediately. Our liquidity pool, we want that yield to drop more slowly for you to get the benefit of the higher yield longer. And that's why we run the weighted average maturity the way we run it. The other component that's equally as important to look at is weighted average life. This is a measure of risk in the portfolio. And this is something where we take the final maturity of every single bond in the portfolio and we weight average that final maturity. Now, what's the difference between weighted average maturity and weighted average life? Weighted average maturity is a sensitivity to changes in interest rates. So for a bond that has a final maturity of 1 year, but a coupon reset of 1 month, the weighted average maturity would be 1 month. The weighted average life would be 1 year. And so that's the difference. So weighted average life can't be longer than 120 days. And so that means that the whole portfolio will, on average, mature in 120 days or less. So this is a sign of liquidity. Additionally, we are not able to buy anything longer than a 397-day maturity. So legal final maturity of 397 days is something else that we use to mitigate risk in the portfolio. And then lastly, I'll say as far as risks is credit selection and credit quality. So when we think about the investments that we're going to make into a liquidity pool, we're thinking about nothing more than 5% maximum exposure. So any name that we buy that has any sort of credit on it, so let's say it's JP Morgan, let's say it's any big bank, Barclays, B of A, et cetera, et cetera. These are big financial institutions. So when we think about putting credits in the portfolio, we're thinking of the largest, most systemically important financial institutions. And even there, we're not owning more than 5% per name. So from a diversification standpoint, you've got a much different profile than you would depositing money at a bank. Collateralized deposit, you're still faced off with that one bank. And we're never saying this is an either or proposition. We always encourage people. I mean, banks are critical. We love banks. We are a bank. We want people to use banks. They're critical to the functioning of our economy. All I want to impress upon you is that the diversification that we're putting in these liquidity pools is much greater than that concentration you have with a deposit at a banking institution. And so with that said, we won't own more than 5% per name in the portfolio. The exception, of course, is U.S. Treasury securities. We can own more than 5% if it's a U.S. Treasury security or if it's a U.S. government agency or repurchase agreements backed by one or the other. Did I cover off on everything there, Ben?
Yeah, no, that's great. That's great. The one question I do have for you, which is interesting, not a lot of people think about this, but can a local government investment pool have a money market position in the portfolio?
They can. And this is a really good question. What we chose to do is sweep into a government money market fund. So that's a money market fund that cannot own credit. It can just buy government securities. And the reason we do this is because it gives us late day flexibility. If we get a deposit in to CSLIP, or if we have a withdrawal from the liquidity pool, we can use this money market fund position to either subscribe or to redeem. And it gives us a lot more flexibility. As you know, the money market world, ever since 2008, that the world has really gotten constrained as far as trading activity in the afternoon. And as much as there can be trading activity in the afternoon, it's much, much less than it once was. And so therefore we see being able to sweep, and I'm air quoting sweep, into that vehicle because it gives us some late day flexibility. It might not always be the best option. We might choose to do a repo or to buy a treasury bill a little bit later in the day. but sometimes it is the best option, and it's something that we can use and utilize. And in fact, I'll go so far as to say money market funds, SEC registered money market funds, can buy other SEC registered money market funds. And so this is something that's very well established and sort of it's considered commonplace throughout the industry and has been really since for 30 years.
Oh, that's great. That's great. Thanks for that, Will. And a question that I got that I still get throughout my career, mainly kind of outside of the Front Range, because I do spend a lot of time on the Eastern Plains and in the mountains. But the question is, well, is CSLIP or any LGIP for that matter FDIC insured? Well, the answer is no, because a local government investment pool is a security. It is not a deposit. And PDPA and FDIC insurance only covers deposits. So as we started this, webinar or podcast talking about how banks collateralize these assets, they only have to collateralize deposits. So when you're as a public entity, when you're investing in a local government investment pool or a money market fund, the key component that I want you to take away from this is the fund collateralizes itself. The underlying securities are the collateralization because the underlying securities, as Will mentioned, are going to be U.S. agencies, U.S. treasuries, high grade corporate notes, commercial paper that meet certain rating requirements, A1P1 or above here in Colorado with the duration requirements. So it's all those underlying securities. So essentially, for something to happen within a local government investment pool with safety of principal being at risk, is if the U.S. government defaults, if we have another Lehman Brothers, AIG, Bear Stearns, and I had a good friend in college that worked at Lehman Brothers, and I was at Morgan Stanley at the time. Just to digress here a second, I called him during the financial crisis right after he was let go. He went into work on a Friday and learned on Monday that he was clearing out his desk. And he said, "I'd love to get those Lehman Brothers in a room." I can tell you that anyway. But having said that, there's that's a key differentiator is when you're looking at the safety of these three options that we're discussing today: money markets, LGIPs, and bank deposits. Well, here in Colorado, recently we've had a bank, and I'm not going to say which one because I personally have an account there. It is a Colorado bank that had some issues, not anything to be afraid about. They didn't have a run on the bank, but what happened was is their tier one capital ratio got adjusted, which means that they had to collateralize more than 102% for every one of their public dollars. So what is the risk to a local government there? Well, the local government risk is you're either going to get a lower yield, or I've seen in some cases 5, 6 years ago where local banks turn away public money because of how expensive it is for them to collateralize and how low the yields are. And then where does everybody go at that point? Because you need to still have a daily liquid option. Well, that's where the local government investment pools really come in handy. Because again, they are self-collateralized, they're daily liquid, they operate just like liquidity function of a bank, but you've got that extra flexibility there. So in fact, take it one step further, just for some education here for everybody on the line of what CSLIP did and the board of trustees and the administrator when we were looking at a custodial bank. We actually looked at three Colorado banks. Two of them we were hoping would have the size to work with the local government investment pool as a custodian, because even if you're a custodian here in Colorado, you still have to collateralize. So what's interesting is we looked at Alpine, Bank of Colorado, a couple others, but at the end of the day, these banks. You have to keep in mind that one of our competing LGIPs is CSAFE, and they have $6 billion in assets. Great fund, great entity, been around a very long time. Having said that, that is larger than all of First Bank's deposits as a whole. So when you're looking at these things, when you're looking at banks, this conversation ties into it. So needless to say, unfortunately, we weren't able to select a Colorado bank to be the custodian just because of pure infrastructure size and collateralization requirements. So that's why you tend to see local government investment pools, not only here in Colorado, but nationwide, have a monster custodian such as Huntington Bank, which is ours, a U.S. bank, et cetera. So anyway, I just wanted to give you kind of an idea there is when you're looking at your bank deposits, everybody thinks that FDIC insurance is the end all be all. Well, it only covers up to 250,000. And then, if there's a bank like what happened out in northwest part of this country, everybody knows the bank. If there's an issue there, how long is it going to take to get repaid and this and that? And I'm not saying that LGIPs are safer than a bank or bank deposits. They're just different. So something you got to consider. If I'm in a local government that has say $100 million in cash, I probably would be looking at something that has a really nice collateralization behind it, something that's transparent, daily liquid, and have a portion in the banking side covered by FDIC insurance. But you really, what makes sense for you is what's going to be best, and work with the me's, of the world to figure out what is best for your own individual entity. But well, I do have another question for you, and we're getting close to time here. But there's rumblings out there about an increase in the FDIC insurance. Have you heard about that? Can you comment on that?
Yeah, no, there definitely is. And anytime you have, bank failures like we saw in March of 2023 when four very large institutions got into trouble and needed some bailing out, then you would typically see that FDIC insurance premium go up for those banks so that the FDIC can increase their buffer that they carry in the event that there's bank failures. So there was a significant FDIC fee increase after 2008. And then we certainly expected one, and one is forthcoming after 2023. Ben, I just want to talk briefly about credit quality and how we think about credit quality because, there's a lot of questions that we get asked about, what about Lehman? What about Silicon Valley Bank? What about First Republic? There's certain names that we would never buy. And it's no disrespect to those institutions. They just don't meet certain criteria for us to put them into the portfolio. So we have a very specific cash credit approved list where our analysts go and pick names, analyze those names, monitor those names. Those go on that list. They can then be purchased into the portfolio. But it's very easy for those names that are on the list to be taken off the list. And I think this is the part that I want to emphasize for this audience, because when we're thinking about the events of Lehman 2008, we didn't own any Lehman Brothers in 2008. Those names had been worked off the list for a variety of reasons. We didn't own any Silicon Valley Bank, First Republic Bank, Signature Bank. Those names never made it on the list for a variety of reasons. So the thing that I want to impress upon the audience is that we are a conservative culture. We look for the highest quality institutions that meet specific criteria around earnings diversification, capital requirements, liquidity requirements, and really the steadiness of their business. And so those are the names you're going to see in the portfolio, and they're household names. And we can disclose portfolio holdings to you anytime. That's not a problem. We want to be very transparent about what we're doing so you really appreciate the scrutiny and the rigor by which we do our job.
Fantastic. Well, that was really important, to discuss there. So thank you for that. Thank you for that. I mean, we covered a lot. We covered, kind of the tip of the iceberg here, and there are multiple more layers on this discussion, but, we wanted to keep it relatively high level. Will, is there any other topics that we may not have touched on that you want to discuss before we open it up to some questions?
Yeah, absolutely. The last thing I will say, and then obviously want to answer questions, is that the yield that our liquidity pool is going to generate is going to be right around the federal funds rate. So when you're thinking about, hey, I wonder what that liquidity pool is yielding, you can obviously check the website, you can call Ben, you can call me, and we'll certainly tell you, but you can also know that it's going to be right around the federal funds rate. So if the Fed raises rates, lowers rates, you can expect that your yield will follow that. And that's a real big differentiator between your deposit rate, because your deposit rate is not going to move according to markets. It's going to move according to what the bank wants to do with that rate. And so that's not a market rate of return. That is a rate that the bank and whatever their strategy is going to determine. And so that's a real big differentiator. So we often like to encourage clients to use a liquidity pool as like a benchmark, and then hold their bank accountable based on that benchmark and making sure that you're getting a fair shake from your banking partners. And like I said, we don't think of this as an either or thing. We think banks are incredibly important in our economy, but they also, sometimes we just need to check on them, make sure they're doing right by you.
No, that's a really great point, Will, and I would add to that by saying, when you're working with a money, if you have your money in a money market fund, you really have to ask yourself, okay, is there something that's going to be just as safe and liquid as this that maybe I could be doing local? So, key word there is in an LGIP, local government investment pool. So we are, here as a free resource for you. My office is here in Denver, and when I'm here, I've spent 5,000 miles in the state of Colorado over the last 8 weeks, visiting participants, adding value. We are a free resource, so please don't hesitate to reach out. I've written many of the investment policies around the state. I've been an instrument in working with local governments for a very long time. There's a lot of different ways that we can provide value. So with that, I'm gonna pause here. We do have quite a few board of trustees for CSLIP on the phone, and we always thank them for their time and truly selfless individuals, volunteering to help put this together for you, the state of Colorado taxpayers. We did see a unique opportunity to create another liquid investment option here in the state of Colorado for your betterment. Competition is always great, and we're here to be a valuable resource. So with that, I'm going to pause and see if we have any questions, from the audience. Feel free to raise your hand with the emoji thing. I'll try to watch for that, or just go ahead and unmute. Hopefully, we don't have a free for all. But if anybody has any questions for Will, you have a fantastic resource here in front of you. Learning from him and his team over the last 9 months, working with them, putting this together has been an amazing thing, and I'm learning every day from him. So utilize him while he's here. He's always available to you. But if you have questions, you've got him on the line.
So I think this could be for either you, Ben, or Will, but several of us deal with either council or board of trustee members or constituents that are so risk averse that it's really hard to turn them around to um, these being very secure investments. And we've talked about a number of things, the collateralization piece and such, but if you were to pick three big points that get across to people, or that we could use talking points to get across to some of these extremely risk averse people, what would you say would be the most effective?
Lisbeth, that's a great question, and this is Lisbeth Lemley, who's one of our trustees from the town of Mountain Village, and that is the ultimate question. Will, my response is probably going to get a little long-winded here. You want to start with that?
Yeah, no, I think it's a great question. So what we'd like to look at is look at history. When have these liquidity vehicles gotten into trouble, and then when have banks gotten into trouble? So that's like the highest level. And then what has happened within the framework of liquidity pools that make them safer? The amount of assets that have to mature within a day or a week have increased dramatically. So it's at least 10% of the portfolio in a day and at least 30% of the portfolio in a week. So the liquidity is huge, and that's something that we really count on. Additionally, I'm trying to keep this brief, Elizabeth. So pardon me if I expand a little bit. But additionally, there are offsetting cash flows in these liquidity pools, right? So the day that someone's redeeming, someone else might be subscribing. So those are offsetting cash flows. And so that's also important when we think about the liquidity construct. So that's liquidity. From a safety standpoint, the only holdings you're going to see in the portfolio are household names. These are the largest debt issuers around the world. They're banks, US banks, foreign banks. But when I say foreign banks, I'm not buying foreign commercial paper. I'm buying commercial paper that's issued by an entity that has a presence here in the United States, and it's issued by that entity. So for what's an example for that? It's Barclays, PLC, New York domiciled commercial paper, right? So these are all this is all debt that's issued under US law and governed by US law. So that's very important from a safety standpoint. So the biggest companies or institutions, globally systemic important institutions, which is hugely important. So that's really those two things, I think, incredible amount of liquidity, incredible amount of safety in the institutions that of commercial paper and other debt instruments that we're buying. You put those together and you've got a very, very steady product that will stand up and has stood up through crises. I mean, we've been managing cash liquidity pools since 1978, and we've had a very, very consistent experience with those returns over that period of time from both a safety and liquidity standpoint.
That's great. Well, and I would add to that is when you're looking at this, I think a big differentiator of CSLIP over some of the other local government investment pools out there is you heard from Will, they are the fourth largest asset manager in the world. Okay, managing billions and billions of dollars, and they manage another local government investment pool in California. So there is a track record there. Okay. What I would also add to that is when you're looking at ABC, always buy Colorado, right? If I am on a board of trustees at a special district, a municipality school district, or if I'm a county commissioner, I'm looking at it, okay, local government investment pools have been around in Colorado. They're regulated by the state of Colorado, and they have a individual board of trustees of our peers. So they have direct control over changes that would need to be made on behalf of the participants in the fund. I think that that is a component that tends to fall down that priority list as you do have that local control. I think that that's something that really does add a lot of value. But the most important thing that you're looking at there is this isn't extending out the curve. This isn't buying individual bonds 2, 3, 4 years out. This isn't Bitcoin. Okay. So I think that with a lot of, there gets to be confusion there at the governing board levels of how do these things actually operate. Again, everybody thinks it's a bank, but it's not. But really, you want to point to, hey, this is what we've already been doing with local government investment pools. It is very similar to a money market fund, just locally regulated and locally controlled. So I think that there is a lot of components in there, but the most important thing you want to focus on is daily liquid, stable net asset value, $1, outstanding reputation of the money manager, the local control. I mean, there's a lot of different components in there. There's so many ways you could answer that question, but I think those are kind of the top three. That's a great question. Anybody else have any questions?
Maybe the one other thing I would offer, Ben, is if there is a board or if there is a person that needs to understand sort of the structure of these vehicles, I'm very happy to get on and sort of walk through exactly what we're doing, how we think about the markets, how we think about risk, what the portfolio holdings look like, how we manage cash flows. How we ensure that safety and liquidity are the primary objectives in the portfolio, what sort of compliance controls we have in place to make sure that our portfolios aren't levered. They're only the assets that go into them are actually go into them. We have front end compliance, we have back end compliance, we have risk management oversight. This is a huge product for us, and it's critical to our business. So we really want to make sure that there is not a thing can go wrong with it, and we take great pride in that. So I'd be happy to get on the phone with anyone and do a deep dive on exactly what we're doing.
Great, thank you.
Well, that's great. It's so funny. You just backed up what I've been telling everybody since we fully launched this thing about 90 days ago and have been working on it for a year now. Is you are a big differentiator of this fund. Everybody says, well, what's the difference between you and X, Y, and Z? Well, X, Y, and Z doesn't have the fourth largest asset manager in the world with all of these resources behind it and the availability. That's something I would say to everybody on this line is you have do some research on Mr. Goldthwait here. You'll be amazed at what shows up, and you might even say, wow, I was on the phone with that guy today. But having said that, we are available to be resources for you again. We're very defined and narrow in what we do. It is just a local government investment pool. We don't buy and sell securities. That's not something we do. We are narrow focused. So reach out to us. Any other questions? I mean, there's a lot of brain power on this from local governments on this call. And anybody else have any thoughts, questions? Okay. Well, as a friendly reminder, this will be posted on our website. If you missed the webinar that we did about a month ago, talking about what Will's forecast and State Street's forecast is for the Fed policy and interest rates coming up, you can see that webinar under the education tab on the CSLIP website. Take a look at our yields, take a look at our service providers, all of that. we are here to help you in any way we can, and our board of trustees is also available to if you want to speak with them, and I can help you coordinate that. But we do want to thank all of you for taking time out of your day. All of you do a truly thankless job. If I compare local government finance officers to a sports analogy, you guys are the offensive line. You do all the work. You get very little of the credit, and we appreciate what you do. We see what you do, and we're happy to be a part of it. So don't hesitate to reach out. Friendly reminder, this announcement on December 5th, we're going to be doing an in-person event in Denver in the afternoon. We're going to have the University of Colorado speak on the Colorado economy, and we're looking at putting together either a panel or having Mr. Goldthwait speak on many different topics. But stay tuned. I'm going to be sending out invites and announcements about that. We are committed to continuing education. We are committed to providing value. Again, that's another differentiator. We want you to be educated. So keep an eye on your inboxes for the December 5th event, but we'll have a lot more of these coming in 2025. And if you have ideas on topics that you would like to hear about, things that you would like us to speak on, we're happy to take a look at all those. And we are working at getting continuing education approval to provide you credit for attending these and not just saying thank you. So stay tuned. We have a lot of cool things coming. We appreciate all your time. Feel free to reach out at any point. We're honored that you were all here today, and thank you again.
Thank you so much.
Thanks, Ben. See you later.
Thanks, Will.
Thank you.
Bye-bye.
Thanks, everyone.
Thanks, Will.